Hey, hello friends. This is Martin from Secrets, the channel for learning about trading and investing. Welcome to Markets Next Week, the weekly stock market analysis and outlook show that we have, where we understand the charts and try to make sense of what really happened in the market during the previous week, and then plan for a better trade for the upcoming day that's beginning from tomorrow, the week that's starting from Jan 29th, Monday 2024. So if you are not subscribed and watching this, please subscribe and share to friends and colleagues so that it reaches out the maximum. We have a summary there, but let's look at the charts to begin with. This is the weekly charts that you're seeing. We are seeing cup and handle breakouts, multiple breakouts, and finally it has reached a stage where some retracement seems to have begun. We never know. And on the right side you have the Banknifty charts, which also shows multiple flag breakouts and cup and handle breakouts and all that, but at the top, very top on the last leg, it is broken down from a consolidation zone. That's clearly evident. That's where we are. Another view of the weekly, we have here the top of a trendline channel on both the indices, and then since the last 2 weeks we are seemingly heading down to the bottom of the channel. It's a daily view, some consolidation with the range bound, and the consolidation is broken down with Banknifty. This is a rally that is 26 to 31% from the very bottom, swing low if you see. That's what this is the candlestick on the weekly that you see on Nifty and the Banknifty that you're seeing here. You can clearly see it's second week of bearishness. Last week also was reasonably good correction, and further bearishness is evident. The small wick indicates an attempt to bounce up from the support zones, and Banknifty on the right side has got an equally big bearish move as far as the candlestick patterns concerned, and also a small bounce up from the support zone. It's seen there. So it's clear bearishness that you see on weekly charts. And daily charts, if you see, it was a truncated week of just 3 trading days, and we can see the last 3 days were kind of volatile with a sharp fall and that cat bounce, and then starting to maintain that gains, and it has formed an inside bar on the Nifty as well as an inside bar on the Banknifty as well. And both of them seems to be a hammer pattern with a long wick size indicating it was pushed down, but there was support from the downside and tried to move up once again to retain the gains that it had done in the mid of the week. So that's what we are. Let's further look at the Bollinger Bands. Left side Nifty is clearly showing still mostly consolidation. Also the beginning of the band's expansion of the downside is also seen there. So overall you can see that it's consolidation with beginning from downside expansion, indicating more further downwards possible. But Banknifty clearly expanded on the downside and continued to be like that, and that's heavily bearish. That's what the Bollinger Bands on the daily is indicating. So before we get into the charts to see the supports and resistance levels, let's just summarize that what exactly happened. So we lost 1% of the Nifty, and we lost 2.6% of the Banknifty on a week-to-week basis. 219 points on the Nifty and 1,200 points on the Banknifty. So clearly the Banknifty has fallen down much more. That's evident from the 8.5% correction as against the 4.5% correction on the Nifty. So clear bearishness evident there, but still a reminder that we were having a big swing move of 17.5% the last bit from the all-time high. The last swing low itself has moved 7.5. But the medium term, if we look, the lower low, lower high is still not broken until the 42,000 of the Banknifty is broken, and that is not happening in the Banknifty as well. But the 20 exponential moving average is still intact on the Nifty, while 20, 50 and 100 bold, all these 3 exponential moving averages are no longer there for the Banknifty. It's Banknifty evident it's much weaker and sharper correction is happening, obviously because of the results outcome is were this triggered to this much. On the daily charts, if you see that it is very volatile, you've already seen that, but on Friday, if you see it's a 0.5% loss on the Nifty, the Banknifty, nearly less than that actually, 100 points and 200 points on Nifty, the Banknifty, negative. Right. So correction has continued basically, further from what happened last week with a sharp fall following the steep result. Now it is 8.8 and 4.5 Banknifty and Nifty respectively. So all eyes would be if the Banknifty would get back some of the momentum to consolidate at least, right, before climbing back. So if that does not happen, and then we have trouble there. Bullish bands we already seen, it primarily indicates expansion downside, although there is some contraction clearly visible. The expansion has already started on Nifty as well. Let's move ahead and see the support resistance also. If you see the Nifty charts, you have a head and shoulder pattern. We just not met the target. It could go as low as 2700. That's a possibility. But if you look at the immediate resistance on the upside, it will be 21700, which is a swing high, and then 21950, which is a gap, and then all-time high of 22125. Downside, the supports could come in at 21, previous swing low, right? That's near the 50 exponential moving average. That's 21,150 nearby that, and 2100 and 125. That zone is a confluence of the previous swing low as well as the 50 exponential moving average, and a gap is also coming in there. So that's a very good support. 21,000 is going to be very good support, and if that's breached, then we go to the gap support of 2700, and then further it could go to the 100 exponential moving average at 2500. That's where Nifty support resistance levels are. Banknifty, which has fallen much more sharper, has got the first resistance that would come at 45,000 first, and then 45,640, which is 100 exponential moving average, and then 46,350 can have some. 46,500 actually is where the exponential moving average of 200 is there. But before that, you have supports at 46,350 and 45,640. All these are resistance basically. Right, so let me repeat that. First hurdle would be to clear past the 45,000, and then 45,640, then 46,000 and 46,350 and 46,500 and 46,555. 46,512 is the 20 exponential moving average on the upside, major resistance, and 45,594 is the 200 exponential moving average on the downside, which will actually support. So breach of all of these will be in favor of that side. On the downside, if this 45,600, that's 200 exponential moving average, is the major support. If that is lost, then you have the 43,960 gap, and 44,000 also is there, very close by. That is also low, so can go down as low as 43,230, which is the first previous swing for support, and then 42,000 way down. Hope it doesn't crash down to that level. But until that 42,000 is breached, the medium term lower higher high and higher low, that pattern is not breached yet if you see the weekly charts. So until then it should be fine. 42,000. So market may be moving in that range between 46,500 and 42,000, and 46,500 would be the exponential moving average, and anything above that would be on the both sides for sure. So that's the resistances. Now let's look at the momentum and the trend indicators. We are using the RSI for momentum, and the trend we are using the ADX. So obviously momentum on the medium term has fallen the sideways on the Banknifty, but the thing is the Nifty has not lost momentum. It's still in the bullish zones, and it also has a divergence unconfirmed, which is positive reverse divergence and bullish image, which indicates that there is a possibility that the market can take a support zone and then bounce up from here. That's seen only on the Nifty, but Banknifty has fallen the sideways and then heading down. That's on the weekly charts that we talk about. The daily charts, right side, if you see Nifty has already lost the bullishness to the sideways, while Banknifty has lost it to the bear zones. It's in the bearish. It could not sustain the climb back to the sideways zones on the Banknifty. So it's in bad shape with respect to the short-term momentum. Nifty is in that sideways, hovering there. So that's a mixed bag. Right. Nifty is in trouble. Medium term, it is not completely turned into bear zones, so that's only relief. Otherwise, it's actually a very weak Banknifty that you're seeing with respect to the momentum. With respect to the trend, you can see that it's short-term bearishness on both the indices, but yeah, so Banknifty has turned completely bearish, on the weekly as well as the daily. But again, with Nifty, the medium-term trend is still bullish, just like the medium-term momentum is still bullish. So Banknifty is medium-term is very strong, while Nifty has cracked down in short-term, really in the bear zones, and trend also is mostly bearish, but managing this a little bit on the medium-term Banknifty. Right, that's what it is. So that's what the trend and the momentum indicators are indicating. So let's look at the volatility and the open interest analysis. So volatility we had already studied using the Bollinger Bands to some extent. Another way to understand the volatility is the India VIX. It is close flattish. Remember, the market had fallen down this week, right? Further fallen down, but the VIX has not spiked up. Ideally, it should have spiked up. So this is divergent. This is contrary to what was expected. That may indicate that this fall may not continue or may not sustain. It's not necessary, but sometimes when the VIX behaves the opposite way as expected, the fall may not be really, the price moves may not be really true for the upcoming is what we may be able to give some bit of prediction. The implied volatility and the realized volatility spread difference, if you see, it's not 17%, it's actually 7%. It has fallen down to 7%, and it's really not in favor of option sellers, primarily with respect to the premiums. Right, so that's something to make a note. Moving on to the open interest analysis, if you see Nifty is showing short build-up, and so is Banknifty. So it's a Friday short build-up on future, so which is clearly negative. But open interest for the options for the Jan 31st and on Banknifty and Feb 1st on Nifty weekly expiries. If you see, the PZR is bearish. 0.81 is not bullish enough, but much better as compared to the Nifty, which is 0.68, which is clearly bearish. Good call ratio we're talking about. Now, if you look at the options open interest levels, you can see that the very wide range is there, where the option writers have placed the bet. The highest betting on the Nifty is at 20,000, where supports are seen, and then 22,500 is where the resistance is seen. So it seems like the option writers have no clues as to how volatile the market would turn out to be, either of the side. That's why such a wide spread is there. Now the second highest put writing is at 21,000 and call writing is at 23,000, way ahead. Right? Banknifty 45,000 is where the put and the call writing. So for Banknifty, the option writers has some clarity, and the range where the highest support is seen at 45,000, and the highest resistance is also there. And the second highest is at 42,000 and 47,000. Right? So that's in par with what the charts are saying. So correlate these and then come out place where you have to bet the support and resistances when you're applying with options and derivatives especially. Right? So that's about the option interest. We'll move ahead and try to see what the sectorial index analysis is talking about. It is a down week. IT sector is down 0.5%. Metal again 0.5%, less than that down. The sector is flattish, but 0.2% down to 0% down. Pharma also down nearly 2%, and FMCG is down 1.3%. Realty 1.5% down, dip up at that. So, but otherwise, if you see across the sector, it was down week for sure. So, the selling has happened, not just specific to bank, like it to some extent what was happening yesterday. So, it is extending to the other sectors actually, but not too much yet, because it's only 0.5%, 1%, 2%. That's all. Now bigger cuts are happening only in reality sector. But if you see the oil sector that's bullish on both time frames and short term and the weekly, which is the pharma. It's a defensive sector stock. The pharma sector stocks are doing okay still. You can still place bets, with respect to the momentum. But we may be having trouble, but the trouble is not serious as of now. But this week went really bad. Look at the charts for the same sector indices that we're talking about. Right? We were about to have a breakout from the cup pattern, not sustained, but momentum is still bullish, medium term. Momentum again still bullish on the metal. We were again having an inverted head and shoulder breakout, which paused with momentum dropping, but still bullish momentum in the medium term. Auto at the top of a trend line channel, all-time line, momentum absolutely bullish in the medium term. Pharma breaking out all-time high, momentum absolute bullish on the medium term. FMCG retracing the top of a trend line channel, momentum still bullish on the medium term. And reality finally has started retracement from the top of the channel, from the all-time high levels, momentum absolutely bullish. So this is something that you have to make a note. The momentum on the medium term is absolutely bullish. Nothing has happened as of now. So until that happens, we cannot say that this is a big major crash or a correction that may be happening. It may be a small retracement, and retracement may not even extend further unless we see across the sector at least sideways. Now all are still in bullish. Right? So it's just some sell-off will happen in specific stocks still is what the charts are showing. So keep that in mind. Now, if you try to understand the major heavyweight stocks that contribute maximum to indices, HDFC Bank comes in the first, and then here we see that HDFC is having a hammer pattern. Look at the selling. Look at the selling the last 2 weeks. Horrific trending. 1,700 levels. It has gone as low as 1,300. So that's 500 points in just 2 weeks. And big cut, big fall, 18-20% more falls, but some bounce up in the big size right at the place where the trend line is going through in the medium term gives a hope that probably the corrections on the HDFC band or the sell-offs may have stopped. But keep that in mind, the momentum has fallen, the medium term bear zones and trend has also crossed over to the bear zones and rising up in the medium term weekly charts. So it's still bearish, but that wick size at the right place of the trend line gives a hope that probably it's over. Reliance Industries is breaking out from rectangular consolidation, was formed the red hammer on the very top. Absolute momentum bullishness is seen there. ICICI Bank also is maintaining the bullishness, but we have we'll try up for a bearish day after that and we'll move up. That's what I'm seeing, a bearish candlestick on weekly is what we are seeing, but momentum is fine. Infosys is doing good. It's trying to break out of that gap resistance. Once it is moved and cleared the gap resistance, you can probably see a big breakout. It's at the verge of that breakout from parallel, but the only trouble is that momentum is absolutely bullish. IT sector assets is going good last week as well. TCS also is maintaining the momentum in the bull zones. Kotak Bank is sideways as usual, climbing up to this, and then it's zigzagging in that range bound move since a very long time. ITC is weak, but it's maintaining the bullish momentum. No, it is not. It has fallen, slipped in sideways. So we have some trouble. Basically, it's a flag pattern with the flag portion, and retracement is happening from the top. Then probably it can go down further to the 425, 400 levels, and then break out, reverse, and then break out from the flag pattern. Absolutely no problem seen there, except that momentum is suddenly swiftly given up the gains and slipped in the sideways. So as of now, if you see the two IT stocks, right, and HDFC Bank and Reliance, so that's quite enough to hold the market as of now. We have not gone into a scenario where the heavyweights, none of them are bullish or all of them are in the bearish. Nothing like that has happened. It's just this hits the bank, and then that's all that has happened as of now. If you look at the heavyweight, so still have a hope with respect to that in the medium term. We will move on to see what happened to the institutional selling. It is a 3-day week, truncated week, and we had 12,200 crores of selling that is coming after 22,000 plus crores of selling in the cash market happened previous week by the Fyers. And the day is trying to manage it by buying 9,700 crores, but it didn't suffice. That's why we have a red week. Nifty longs and the derivatives are also moved on, as you can see there. But if you see the institutional participation on the F&O, you can see that FIs are strong bearish on futures and mild bearish on the options. So be careful. The pro traders and the retailers, brokers, and all that, they are kind of strong bullish on futures and options, except that retail brokers are slightly bearish on the options. That's F&O analysis for the institutional participation. You know this, futures, strong bearish on the futures and options by the Fyers. No trouble. Our indicators that probably next week also could turn out to be more selling and more bearish moves. We'll try to understand the global markets, the global commodities, and the currencies. Beginning with the currency, the dollar index has moved up flattish up 0.24. And it's at 103.47. Remember, we had a down mode of 6.5% ago. The charts of that is can be seen there. It's a cup and handle breakout which failed to sustain, reached in the neckline, and then trying to move further up. However, the USD and our charts that you're seeing, it has been hovering in that ascending wedge since very long time. Is managed by the central bank, and then it remains to be weak at 83.1. Continue to remain the weak since very long time. Moving on to the crude oil, we have some troubles that may be upcoming. Trend line, support, consolidation, and then spike up, big spike up week. Oil must climb from the bear zones. Where we are happy as an oil importing company. Now we have trouble coming with the spike in the momentum, the sideways heading towards the bull zones. This trouble if you break out of this trend line channel at 85 plus. We may have trouble. That's not a good news for last week what happened on the crude oil. Looking at the gold, it had earlier broken out and made new all-time highs but could not sustain the sell-off. Neither is it ready to break down. So this is a head and shoulder or rounding cup, all that pattern breakout that did not sustain, but it has fallen to a sideways as of now. So it may be consolidating at these zones itself for a long time until the right time comes for it to break out and make new all-time highs again. But as of now, sideways, flattest consolidation, what you see in the gold, right? Let's see hedging instrument. Moving on, if you see the US markets, we have the green once again for the second or third week now. It had been rallying since several weeks, just like our market, and it has broken out and made new all-time highs, and then have a green close once again on the Dow Jones of CC with momentum in the bull zones. Nasdaq also slightly indecisive at the very top with a doji. You have to be careful, but still managed to close green with the momentum and this trend absolutely bullish. S&P 500 also made a 1% move in green, momentum bullish, trend bullish. So we have overall green 0.65% Dow Jones, 1% S&P 500, and 0.6. So again Nasdaq up, absolute bullish momentum. So that's very good news that the mother market is bullish. So that's a summary. We have currency is doing more or less the same with some spike on the dollar index, and so oil potentially could create trouble as it spiked up 6% this week, and gold at the top consolidating, and US markets green. So overall, not that bad news except for the crude oil. So now that with the analysis system, let's move on to two stock picks for the next week. It's Asian Paints. It's a short call. It's a short trade. Look at the momentum. It has slipped in the bear zones. Criteria number 1 on the weekly. And look at the trend. It has crossed over in the bear zones. Criteria number 2. Criteria number 3. The price pattern is at the brink. at the end, at the edge where it could break down from that consolidation. So if that happens, that's where we again could be restored to the reasonable good volumes. Look at this, last 2 weeks heavy selling happening on this. You could find support of the previous swing lows. You can trade from there, but yeah, reasonable risk reward trade. Enter only if the price moves below this week's candle's low. It's a short trade, Asian Paints. Now Cipla, it's a long trade, still a long trade because it's a inverted head and shoulder pattern, bullish in nature, which had broken out, followed the selling pressure. So you can have a tight stop loss below the neckline of that, right? Very small stop loss, and then you can, if it flies, you can have a good reasonable swing trade opportunity on the long side, upside, right? 1:2 or 1:2, 1.5, whatever you wish to, if that happens. So because criteria is bullish, patterns bullish, trend bullish, momentum bullish, right? Small retracement trend is probably an opportunity for you to get in if the market moves up. Otherwise, small tight stop loss, take the happy loss and get out. Another actionable is on the Nifty weekly option strategy. This is a peer call. We sell a call on 21,500 for the upcoming expiry, and then we buy as a hedge 650, much higher option. We buy it net to net. Probably profit is not that great, but very reasonable range that we'll get, and if the market falls, we'll only gain. And portion size based on our capital size and risk appetite. And that's a weekly option strategy, very simple plain bear call spread. Let's just wrap up. Market continued to fall, correction continuing, but it was a 20-year week, but volatile, sharp moves and some recovery. But otherwise, we have retraced 4.5% of Nifty and 8.5% of Banknifty, while we had rallied 26 to 30% from the very last swing low, with multiple cup and holder patterns and rounding and flag patterns and all that. So what points are in favor of the bears is the candlestick patterns are not bearish. Momentum is dropped in the bear zones. On the short term, on Bank Nifty especially, Nifty is sideways and heading towards the bear zones. Trend is also in trouble in the short term. Big selling by the Fyers is happening in the cash market. Continue to happen. 20,000 crores, 10,000 crores. Right? This kind of selling is really bad. And Bollinger Bands are showing that there is downside expansion, heavily indicating what could happen on the Bank Nifty downside. And Nifty also is just beginning with expansion on the downside, and it is not corrected much. So there is a very good chance that it can do that, at least to catch up with the Bank Nifty. So that's in favor of the bears. And open interest, put call ratios are clearly bearish, right? On the futures as well as the options, both are bearish. Now, what's in favor of the bulls? FIS, US markets. That's great. VIX is still not spiked up to the 20 levels or something. It's still under control of below 14. The medium term, the bullishness is still there across the sector indices, and it's bullish in the Nifty still with respect to momentum and the trend, both medium term. And so the factors in favor of the bulls. So market has finally done some correction that was due long time after vertical moves earlier. It has done a little hard, a little steeper on the Nifty. Last week it was a very strong week, but still very volatile, doing up and down moves. And the correction is 600 Bank 58.5 and Nifty 2 just 4.5. So more could come in there. Once again, I'm repeating the same thing here. The short term trend is bearish. Bank Nifty has done decent correction. Probably bulls can hope that it may consolidate now and then eventually get back to catch up with the Nifty. That's a possibility. But if that does not happen, then the Nifty follows the Bank Nifty. That means more cash will happen. If I continue to sell the bank stocks or specific stocks, then obviously Bank Nifty will fall, and then eventually the buying stock on Nifty and Nifty also will fall. So let's already keep an eye out. Watch on what is happening in Bank Nifty. Is it consolidating? Is it getting back to momentum sideways at least from bear zones? Or is it further falling down? So we'll keep a close watch. So it all depends on that. Technically, charts lost the momentum. It's in short term sideways movement as of now. Not at bearish on both. So if you're going directional on the downside. We'll have to wait for the Nifty also to go directional downside. Nifty also to get into the bear zone in the short term on the momentum perspective and the trend perspective. It does not happen, so we just can't do that. We can do it only on Nifty as of now. So technically still sideways if you consider the Nifty 50. So the market view concerning all the different parameters that we have studied on all the indices, sectoral indices and all that, my stand is neutral for the next week. Neutral too with a mild bearish bias. There could be some more fall that may be due that can happen in Nifty, and then some consolidation eventually by the end of the week or something. Right? That's what I'm looking for. So mild bearish bias is there, but however I expect the market to consolidate after having 2 weeks of sharp falls, and it's happened for no reason, just specific one stock results outcome taken as a reason for the Fyers to clean up. So once again, a reminder that the global cues could turn suddenly bad with such interest rates and inflation as well, COVID and all these things. So trends could come in any time, and so very cautious. All that we can do is manage our risk. So do that properly. Just study the probabilities and place your bets on, and support resistances that we have been studying technically. That's all right? Probabilities and the data, in addition to the support resistances, that it has to correlate both. So next week 2700 could be a good support zone. There's a gap there, and 21950 in the upside also could be a major resistance because there is a gap there, and a lot of previous supports could act as resistance on the way upside. Banknifty 42,000 to 47,000 is where the highest put and call. Highest support and resistance is something very wide range because Banknifty is violent and it's very volatile. So I repeat that the 21,000 on the Nifty and 47,000 on the Banknifty. This is required for the rally to take the next step, and as long as it does not happen, it may be just consolidating or maybe crashing down. That's a level that you keep in mind. So once again, as I always say, every dip can be a buying opportunity for the investors for long-term quality stocks, not in bulk but in short, small chunks. This may be opportunities for you to do that. Also, you can make use of this fall to gain from options as well. There are different option strategies like put call, covered calls, and cash secured puts and all that. That will give you rental income when the market behaves this way, like against the stocks, against the trend. Basically, for example, HDFC Bank. Right, you have investments in that, but HDFC is falling down against what you wish. But still, you can make money. You can get rental income as long as this down move happens using this strategy. So look out for that. So once again, productive capital. Bearishness is evident on the Banknifty. Nifty does not happen. That is an indication that there is every potential for it to follow. So that may be opportunity for you to do some downside directional trades. If that happens, there may be an opportunity for you to do that. At the same time, you have to be cautious that Banknifty may end this drama and then join back to the Nifty to take the next leg. So all this probabilities are there. So play it safe. That's all I have. Subscribe to the X or Twitter or whatever social media channels where we have the postings regularly. So if you don't want to miss out, subscribe to them. The intraday trade charts, postings and all are there in the social media channels. But this analysis daily is there at the end of the day, and weekly we have a summary which we are listening to. So that's all I have. If you have liked it, consider hitting the like button, then put in your feedbacks and comments and whatever, and subscribe definitely if you're not done so, and then share it to your friends and colleagues that will help Max. Thanks for watching. Happy trading, happy learning, happy investing. Bye bye.